Hey there, my name is John Stevenson. Welcome to the Guaranteed Retirement Guy Show. Today we're going to be talking about how to structure your annuity using the laddering strategy so that you can outlive your money. Okay, so if you're thinking about your money, your portfolio, and you're thinking, all right, how can I make sure that I use as much as I can without running out? Because I don't know how long I'm going to live. I hope I live into my 90s, but what if I don't? How do I make it so I can still use most of my money, if not all of it, before that happens? Okay, we want to maximize our experiences. We want to maximize our lifestyle, but at the same time, we don't want to maximize it so much where we run out too early. Okay, and maybe you want to leave something to your kids. Okay, that's important too. Sometimes it's not important though. So it just depends on you and your kids and what situation they're in. Sometimes people are in a spot where their kids are great. They're great financially. They're self-reliant and they do not need the support of their parents. So, and they encourage their parents to spend all their money because in reality, it helps the kids more because they feel like they don't have to support their parents as much and they don't feel like their parents are going to come and ask them for money later on. So, and there's arguments for and against that. But anyways, in this video, I'm going to show you how to use annuities to get you as much as possible. And then you can still leave money to your kids. I mean, annuities will, if you don't use it all up, it'll leave whatever's left in there to your kids. But for me and my wife, we're leaving our house and stocks and things like that. So let's take a look. I'm going to show you my screen. I'm going to show you how to ladder this out for yourself. Okay, so this is someone who lives in Pennsylvania. They're 62 years old. They got $750,000 and they are not necessarily taking income now. Although if they do, you can see the annual income's like 44 grand. Okay. Actually, you know what? I think it's more than that. That's with no rider fee. So let me go down with the fees and you could pick ones without fees. That's totally fine. But obviously the income is definitely higher if you choose one with a fee, and the fee comes out of the account balance. It does not come out of the income. So it'll, if you're looking for highest income, it makes no sense to not pay the fee because your account balance is going to run out anyways. It'll just run out a little bit faster. So, but the income is guaranteed for life. Okay, so let's take a look at this. So if I want to ladder, a laddering strategy for outliving your money is basically you build a series of annuity payments. Okay, annuity contracts. I mean, I've got clients that have 10 of these. And some have 3 or 4. So everyone's different. Some people only have 1. It just depends on what your unique circumstances are. But a lot of times what people say is they're like, John, I want this base. We need this much. We're going to have Social Security on top of it or a pension or whatever, and then we're good. But 10 years down the road, that annuity payment's the same. Unless, of course, you get one with with an increasing one, but then that starts out a lot lower. That's a different conversation. We can talk about those. But what's going to happen is in like 10 years, I want to activate my second annuity, okay? The other part of my ladder. And then maybe another 10 years, activate the other one. Okay, how will this work out for me? Like, can I take advantage of current annuity rates to lock in a high growth period for myself to ladder these out and to be able to take as much income as I can and using, a portion of my assets to be able to just give myself as much income as possible, taking way more out than I would normally take out of my retirement account, but it's contractual, so it doesn't matter. How do I do that? Well, what we would do is and I'll just show an example from this client. Let's say, just to make the math easy, I'm going to say this client has $3 million, okay? And they're going to take half of it. They're going to take half of it and buy annuities. So they're still leaving the other half in the market. That's going to grow and compound like crazy, right? So, but let's say they're just going to take half of it and say, we want to set up our base, okay? All right. So, and we're not going to retire, even though we know we could take income, which is, 55 grand right now. We want to wait because we're not going to start Medicare until 65. We're going to work that long, and that's fine. Most people will choose to wait, especially if they're looking for more income. So some people don't. They're like, no, I want to retire now. I want a vacation. I want to live it up, which is great too. All right. So, but if you let it defer, the power of compounding is pretty big. So it goes from 55 to 72. Okay. So if I was to choose one of these, I would say do Nationwide because they're just A+ and they're 100 years old and the income's about the same as Equitrust. Equitrust is great too, and they give you enhanced payments, which are like LTC. They give you a doubler if you need it, but it doesn't last very long. But it is there, and they're a good company too. So it just depends on what you're looking for. But I'm going to, for this example, use Nationwide, and I'll say, okay, this is the first rung of our ladder. Okay, we've used 750. Now remember, I said they're going to use half of 3 million. So they're going to take the other 750 and purchase they're going to purchase 3 more contracts, okay, $250 each, okay? So we'll look at that and say, okay, 72 grand, this is our base. Our Social Security is 30 grand, so now we've got income of 100 grand a year. We're good. We're going to travel, we're going to do what we want to do, and this is perfect because we got all our debt paid off, okay? So you'll notice if there's no index growth, then the account balance runs out by the time they're 74. If there is index growth, then the account balance lasts like four more years to like 78. Either way, the money in this account runs out, but the income does not. Because remember, we're structuring annuities to outlive our money. Well, if you live till like 90, you've been taking income for a long time beyond the account balance. And you've been taking it at a 6.25% withdrawal rate, much higher than a 4% safe withdrawal rate that a lot of advisors argue that you can do. Okay, so that's pretty good. They're taking a 6.25, multiplying it by a 1.162 million pension value, and they're giving you that income for the rest of your life. Okay, now, if you want to argue the safe withdrawal rate, then I'll just say, all right, let's say the pension base has no growth, and we'll just base it off the 750. Okay, you want to do that? That's fine. We can do $72,000 divided by $750,000. That comes to a 9.6% withdrawal rate. Would you normally do that? Would you pull 9.6? Would you pull 10% out of your account? Probably not, because if you look at the S&P 500 over the last 100 years, it's averaged 10. You're like, okay, well, we're going to have some down years, sequence of returns risk. Okay, that could be a problem too. So, but with an annuity, it's not about that. It's about contractual guarantees. It's not about growth. You don't care about the growth. You've been growing it. Now you get to enjoy it. And so this is what you set it up for. So this is the first part of the base. Now, remember I said we're using 3 more contracts because they decided, hey, we're going to use $1.5 million. We're going to use $750 for our base. And maybe that's different for you. Maybe you're like, no, that's not a big enough base. I want $1 million. Okay, I need $1 million, and then I'll take my other 500 grand and I'll buy 2 more contracts. Okay. So if you do $1 million, $1 million, let's just look at that real quick. $1 million, 65, 97 grand. Pretty good. Okay. So let's say you do $1 million. You're like, all right, $1 million is my base. Get almost 100 grand. Got my Social Security and my pension on top of that. We are good. Right? But, 5-10 years down the road, I'd like to activate some other contracts. Okay. All right. So we'll just say you bought 2 more contracts of $250 each. So we're going to go back here and say, okay, so we got these other contracts we're buying, and we're not going to start these ones until later because at 65, we've got our income that we need. So maybe at 72, we'll activate the second contract, the one of the 250s. So based off of that, all right, so we're getting another, if we want to stay A-rated, and we're still good, 40,000, 44,000, somewhere around there, even if you did another nationwide. This one's the New Heights product, which is different than the other one. But yeah, I mean, you grab another 42, 43 grand, throwing that on top of your income, that's pretty huge. And then, of course, you got your third annuity that's been sitting there. And you might decide, I'm going to activate that when I'm 78. Okay. Just get some more income from the same from the third 250. And now, of course, American Equity is the top one. And it's like 64,557. So now between the 3 contracts, you've got almost 200 grand in income for life. It's really good. That's over 200 grand. So, and you'll notice that the first million, okay, gave us almost 100,000. We're like at 97 grand. And then you notice the second $500,000, right? Because we only used half of that, not the full million, but we deferred it out. That's the laddering strategy. You defer it out for a long time. Then that $500,000 gives us 64 plus like 44 or 43. That's like $108,000. Okay, you got more income. You got like $7,000, $8,000, $9,000 more income. I can't do my math. $10,000 more in income from half the money. And that's just because you laddered it out. You created a ladder strategy and you said, all right, we need a larger amount for a base that starts sooner, right? And then, of course, we're thinking we'd like to have raises later on. And over time, it's going to, raise our income to like 140 and then to $200,000. And then, of course, we've got our Social Security that's going up at the same time. That is how you ladder. And that's how you use a portion of your funds to do that. Okay. So it's just, if you know how it works, it can work very well. And people always wish, in hindsight, man, I wish I knew about this 10 years ago. Well, now I'm telling you about it, so you don't have to say that. But let me show you real quick how this works. So I'm going to show you the ladder. So if we look at, let me just pull up American Equity here. All right, so American Equity, the reason why this works so well is American Equity, they actually give you a 6.5% roll-up rate, compounded for up to 20 years. That's why it works so well. So they're not very competitive in the beginning, but they are made for longer-term ladder strategies. So if you look at this, the benefit base grows from $250,000 to $303 in the first year, okay, because they're giving you a bonus on top of that. So then it continues to compound at 6.5 every year. And you notice at the end of 16 years, you've got a $780,000 benefit base, but you also have a lifetime withdrawal rate of 8.27. That is huge. And when they're multiplied against each other, it gives you $64,557. If you decide to take income earlier, which you certainly can, okay, when you build out these laddering strategies, you're not setting in stone the date you're going to take income. You can take it whenever you want, but you're just setting yourself up so that you can take the income at any time, knowing what it'll be if you wait to certain intervals. So in this case, if you wait 10 years, you get like an extra 38 grand from this contract. Okay. If you wait, 13 years, it's 49,000. Okay. And so on. 16 years, it's 64,000. So it's just the longer you let it grow, the more you get. And they are charging fees. You can see the rider charges here. Here's the rider charges. And they're charging fees. It comes out of the account balance, and they're showing you this as worst case scenario. If the account's not earning anything, which it'll earn something. It's tied to the S&P, and they'll give you some of the S&P because they're buying call options. So you're not in the market, but they're still giving you some of that growth based on those call options. So if you look at the growth side, you're like, well, if it does grow, it's still not going to grow very much, right? You have some growth, but not much. I mean, it'll grow to maybe 350. So, but it doesn't matter. Eventually, the account balance is gone, which is what it's designed to do. It's designed to give you lifetime income. That's what it's for. Okay, so you're taking a 250 and you're buying almost a $1.2 million pension just with that 250. So this is how you generate millions and millions of dollars worth of income, lifetime income, from a relatively small portion of your assets. But if you don't want to use a small portion, you can always use a larger portion, but you can only go up to like 75 to 80%. That's the highest these carriers will allow you. And you really can't go higher than that. You need to have liquid assets outside of this so that you have, something in case of an emergency. Okay. You have to have this, but you can still use a large portion. I mean, if you were in a position where you're like, I got $3 million, I want to use all of it. Well, you can't. You can probably use 3.4 million. Okay. And so if you were to do that, then basically double all these numbers, okay, more than double them. And you get more income for yourself, enjoy it, especially when it means the most. And just set yourself up for a really good retirement. So anyways, hope this helps. If you like the video, like, subscribe, share, comment below if you got more questions. If you want to purchase an annuity with me, then call. Actually, probably the best way to do is just click the link below this video, and it will go directly to my calendar, and you'll get a Zoom call link, and we'll get on the meeting and we'll chat. If you want to check out annuity payouts first, which I highly encourage, then go to my website, johnstevenson.com, check them out. And then if you want to, you can book a call. Now, keep in mind, when you're looking at the income rider quotes, the top 3 or 4 sometimes will show accelerated payouts, okay? Accelerated payouts, they are optional annuities that will give you more income earlier, but much less later on. Okay, so Ameritas, NASA, American General Life, a lot of times will show a lot of their options at the top of that. So just keep that in mind. They are good for certain purposes, especially if you're looking to bridge an income need for a certain period and you're okay with it going down like 35 to 40% later, then fine. But the ones that I'm showing you here, they don't reduce. Okay, they are for life. They're guaranteed for life, and that is really what most people want. They don't want it to go down. So anyways, hope this helps. I do appreciate you for watching, and we'll see you next time.